There's a belief that most people share, and it goes something like this. Inflation is just a grocery store problem. You see it when you pay for food, when you fill up your gas tank, and when your other daily expenses go up. And the fix, most people think, is simple. Earn more, spend less, and keep saving. But here's what most people miss. Inflation doesn't just affect what you spend, it also affects what you've already saved up. And if you're sitting on a meaningful amount of cash right now, say $20, $50, $100,000, even in a high-yield savings account, you are losing real purchasing power every single month, whether your account balance shows it or not. And that's what we're covering today. Okay, but before all that, if we've never met before, my name is Ernest. I'm a technology professional, a United States Air Force veteran, and a real estate investor. I built my financial education the same way many of you are trying to, while working a W-2 job, managing a budget, and investing what I was able to save. Today, I am proud to own multi-million dollars in rental real estate. And everything on this channel is designed to help working professionals cut through the noise and make clearer, more confident financial decisions. Okay, let's get into it. Here's what we're covering in this video. First, we're going to break down exactly what inflation does to the hard-earned money sitting in your savings account and why most people underestimate the damage that inflation causes. Second, we're going to run the real numbers on a high-yield savings account right now, including what you actually keep after taxes and inflation. And third, we're going to talk about what all of this means if you're someone sitting on a lot of cash while trying to figure out your next move. So let's start with a distinction that almost nobody makes but actually changes everything. The difference between inflation on your expenses and inflation on your savings account. So inflation on expenses is what you already know. Prices go up, things cost more, and your paycheck buys you less. You feel this. You literally feel it every time you go to the grocery store or the gas station. It's frustrating, everyone's talking about it, and you hear it every time you listen to the news. Inflation on your savings account is different. This is what happens to the money you've already saved. Every time expenses go up, you lose some of the purchasing power of the money in your savings account. And here's the problem. You don't feel it the same way. Inflation on your savings account creeps up on you. Your balance go up slightly each month thanks to interest and the number looks fine. But the balance that shows in your savings account slightly going up and building meaningful wealth are two very different things. Alright, so let's put the numbers on it so it's easier to understand. Let's say you have $50,000 in a high-yield savings account. And as of 2026, competitive high-yield savings account rates are running around 4 to 4.3%. And so let's use 4% just for easy math. On a $50,000 balance, that's $2,000 in annual interest income. And yeah, that sounds reasonable. But here's what a lot of people forget or simply just don't know. That interest is taxed as ordinary income. And if you make about $100,000 as a W-2 employee, you're likely in the 22% federal tax bracket. The $2,000 annual interest income on your $50,000 saved up goes down to only just about $1,500 after taxes. And so the increase in your savings account drops from 4% down to about 3%. Now subtract inflation. Current inflation is running around 2.4% annually. With that inflation rate, your actual after-tax return on that $50,000 balance is approximately 0.6% per year. And so that's $300 in purchasing power you gained over an entire year of having $50,000 simply parked in your savings account. Let me say it again. $300 in annual interest on $50,000. That is not a strategy. That is barely a movement. And it's worth noting that rates on the high-yield savings accounts have been declining from their peak in 2024. If rates drift down this year, which many economists expect, your real after-tax return could go flat or turn negative. And at that point, you're definitely losing purchasing power every month, even if the balance on your savings account stays the same. Now, I want to be very clear about what this means and what it doesn't mean. I am not saying to drain your emergency fund. Having a 3 to 6 month reserve in liquid cash is very important. That money has a specific purpose and it should stay liquid. This video is not a pitch to take reckless risks with money you need for actual emergencies. But here's the honest question. How much is just money that's been sitting there while you figure out what to do with it next? If you have $50,000 in your savings account and you only need $20,000 for your reserves for emergencies, the other $30,000 is money being taxed silently by inflation the entire time it sits there. Here's a great way to think about cash. Cash is just a temporary storage of value. An emergency fund is cash that's there for a very specific reason. If you hold cash for a defined goal, say like a down payment you'll use in the next 12 months, that is also another very good reason. But if you're holding cash indefinitely while you wait for the right time, the right market, or the right interest rate, that cash is losing value that's easy to ignore because it's barely noticeable unless you really think about it. The people who build real wealth consistently don't treat cash accumulation as the final destination. They only look at it as a launching pad. They hold enough cash to stay protected and flexible, and they deploy the rest into assets that generate returns above inflation. Okay, so let's think about what that difference looks like over a 10-year time frame. On one hand, someone who keeps $50,000 in a high-yield savings account for a decade ends up with roughly the same purchasing power they started with, maybe even slightly less. While on the other hand, someone who deploys that same $50,000 into an asset that builds equity, collects rent, and actually benefits from inflation rather than against it. The gap between those two outcomes is not about taking risks. It's about understanding what each strategy actually does with your money over time. And so here's the single thing that I want you to take away from this video. Your savings account is not protecting you from inflation the way you think it is. After taxes and inflation, the returns on your savings account is near zero. And that number actually goes down over time. And so the goal is to find an investment vehicle that significantly beats taxes and inflation. And so in my next video, we're going to get into something really interesting. We're going to break down exactly why and how real estate actually benefits from inflation. Not in a vague prices go up kind of way, but the specifics that make the strategy work. If this landed for you and you want to go deeper, subscribe to my channel and make sure you don't miss the next video. And if you're sitting on savings right now and you're interested in investing in real estate, see the link in the description below. I created a personal assessment that tells you everything you need to know before you buy an investment property. Alright, so that's it for now. And as always, here's to your success. Keep learning, keep investing, and make your money work for you.